During times of extreme volatility in the markets, with levels that we haven't seen since the Great Recession, many stocks offer incredible value. Now, as an investor, you may want to err on the side of caution and actually stick to large blue chip companies which have a proven track record over time. And there's absolutely nothing wrong with that strategy. However, if you are a younger investor, you may be able to take on more risk in your portfolio. And if that's the case, blue chip companies may not be as appealing to you. So in today's video, I'm going to be talking about 5 high growth companies that I think have huge potential after we come out of this 2020 recession, stock market crash, whatever we're going through right now. But just keep in mind that most of these are extremely volatile companies. Also, make sure to stick around for all 5 because one of them may surprise you. But as usual, guys, if you appreciate this video, it did take a little bit of time to research this. But if you do appreciate it, all you have to do is hit that like button down below to show your support for the channel and this video. If you are interested in what stocks I'm personally purchasing right now, link is in the description down below to my VIP group, so check that out if you are interested. Anyways, guys, let's get into the fun stuff. So here's stock number 1, Square, which is down around 55% from its all-time highs, which it actually made back in late 2018. It started clawing its way back to those highs recently, but since the volatility hit the market, this stock has gotten hit hard as well, and is now sitting at prices that we saw in late 2017. Square, if you're not aware, is a payment processing company that allows small businesses to accept credit cards without having to go through a complicated system. Vendors can use their phone or tablet to accept payments, and Square makes money because they take a cut of each of these transactions. They offer other services to their customers as well, like payroll management and such, and this is completely optional to add on if vendors are interested. But as you can imagine, recently with small businesses suffering during these tough times, Square also gets hit because there aren't as many transactions being made on their platform. This, of course, is a short-term issue in my opinion, but has hurt the stock price in the short term. Square is a hyper-growth company growing at 43% year over year and over 40% over the last 5 years consistently. This is a sign of a healthy company that is in demand. Their EPS has also been growing well and is expected to continue growing well, but like we said in the short term, these figures will need to be adjusted due to recent events in the market. Square is also a profitable company and has a current market cap of under $20 billion, which means that this company has tons of room to grow when the economy does eventually recover. Stock number 2 is Uber, which is down almost 60% after they IPO'd back in 2019. Now, this stock really held the $30 level for quite a while, but the recent market sell-off has taken Uber hostage as well, bringing their share price to well under $20 currently. And what's crazy is that this price is below their IPO price. Now, Uber, of course, is the world's largest ride-hailing app with exposure all over the world and with services that consumers cannot live without anymore. Ordering an Uber is extremely simple from the app, and within minutes, you have a car at your door waiting to drive you to your destination. Everything is routed on the app, and best of all payments are processed there as well, so there's no money exchange done in person. This is the future, and Uber will only continue growing as they become bigger in other countries around the world as well. Recently, Uber has suffered because many cities have been shutting down events, restaurants, and bars, and there isn't a need for people to go outside anymore. As a result, there's less rides being ordered. However, the one silver lining here is that Uber also owns a food delivery business, Uber Eats, which may actually do quite well during these times. We'll have to wait and see in an official statement or during their next earnings report how the Eats business did during these lockdown periods, but I think this actually could end up being a good thing for the Eats business. Now, Uber has a revenue growth rate of over 25% and over 54% over the last 3 years, which is incredible growth considering their size. EPS growth here is huge, well over 50% in some cases, and 70% expected in some cases year over year. But the one thing to make note of is that Uber is still not profitable. So with this company, you are taking on more risk with the business, but if things do go well, they should be profitable in the next year or two. Uber also currently sits at a market cap of around $30 billion or so, which is incredibly undervalued for the value that this company provides the world, really. And in my opinion, I think that this company can be well over $100 billion company. Stock number 3 is Lululemon, which is a very interesting company because it's never really intrigued me before this dip. It's down over 45% from its recent highs, and it's all due to the recent events happening in the world. As a retail or apparel related stock, and one that isn't really essential right now for working from home or for survival, they are feeling the pain of consumers staying at home and not spending much money. Lululemon, like I mentioned, is an apparel company, and they are best known for their yoga pants that women love. They also sell other clothing for men as well, and many people swear by their quality despite their premium price tag. It's a premium brand that mainly focuses on athletic type materials in their clothing with a focus on comfort. Now, Lululemon doesn't have as impressive growth numbers as the others we've discussed so far, but it is a company with double-digit growth, which is what I'd still consider a high-growth company. Most recently, their revenue grew by over 20%, which are impressive figures for a company that competes in apparel, which is a tougher space. The EPS for Lululemon is also not mind-blowing, but still very good and still high growth. And this company is a profitable business, which gives you better stability here for an investment. And this company currently sits at a market cap under $19 billion right now, which is very tiny in my opinion, considering the brand that they really built. Many people who own their clothing or choose to buy their clothing for the first time become brand loyal to this company and choose to own their clothing moving forward, which kind of makes them a very sticky business as they acquire customers for life. Stock number 4 on our list here is Slack, which is down close to 50% since they IPO'd in 2019. What's interesting is that I think that this business can actually do well during current times. Slack is a software company that competes with Microsoft Teams, and they provide companies ability to go and allow their employees to collaborate quickly and easily. This helps to increase productivity and keep things organized as well. And now with the shift for work to home really for most companies with the situation we're going through, Slack should see a nice uptick in orders as businesses rely on platforms like theirs to help their employees stay more productive during these times. Once again for Slack, we see some hyper growth here, 57% over the last year and over 81% year over year in the last 3 years. EPS for the most part is expected to grow nicely this coming year, and like I said, we may actually see this do better than expected with the recent work from home initiative. Slack has a tiny market cap of under $10 billion, mainly because they are new and they are not profitable and they have some big competitors like Microsoft to fend off. Will this company prevail? Only time will tell, but I can tell you from seeing this platform firsthand that it is designed for the younger generations. So what I can see happening over the next few years is that as millennials kind of take over more decision-making roles in companies, they may choose Slack over Microsoft Teams. And as newer companies kind of become bigger in the workforce, they will also most likely choose Slack over Microsoft Teams, just because, like I said, the interface is geared more towards the younger generation. Now, the last stock on this list is going to surprise you, and you are going to be glad that you stuck around till the end of this video here. This stock isn't like the other stocks in that it is extremely stable, it is extremely profitable, it's one of the largest companies in the world, but it still has some crazy hyper growth. Stock number 5 is Facebook, and this stock is down over 33% currently, but for a company that's over $400 billion in market cap, that's a lot to be down. Facebook, of course, owns a Facebook platform, they own Instagram, they own WhatsApp, and their main revenue source is advertising. During these tough times when everyone's working from home, they're usually on Facebook during the day, checking Instagram more often, and all of this is good news for Facebook. This means that more users will be using their platform, and they'll probably report some strong numbers this upcoming earnings report. Now, because there's so many people on the platform, it's going to entice advertisers to really cut their spending on other platforms like print media or TV and spend it on platforms like Facebook. Because not only are you going to be able to reach a wider audience, but you are going to be able to target your ads as well to certain users, and it's typically cheaper, and you have higher conversion rates in most cases, so it's pretty much a no-brainer here for companies to advertise more heavily on Facebook. But now here's the shocking part. For a $400 billion company, their revenue last year grew by a whopping 26%, and in the last 3 years has been 36%, and the last 5 years has been 41%. Now you may be thinking this isn't a good sign as the trend is declining, but this makes sense as they become so large, naturally the growth percentage will slow down as they capture more and more of the market available. EPS for this company for the most part is also very impressive, near 20% consistently year over year, which just adds to their $40 billion plus in cash that they have lying around. Facebook is really what I'd consider a blue chip company, and I think their growth can still keep going at this pace for quite a while as they continue to monetize their platforms like WhatsApp, maybe earn cuts from transactions on Facebook Marketplace, or even help influencers sell their products on Instagram, with Facebook taking a cut of that. The potential for this company is huge, and I, for one, would consider Facebook both a blue chip stock and a high growth stock. You kind of get the best of both worlds here with this company. So what do you think? Would you invest in any of these 5 stocks that I talked about here today? Of course, another big one that we didn't cover here would be Tesla, another high growth company that I think will do extremely well over the long term. But the stock has to come down quite a bit more for me to be interested in investing in them once again. Let me know in the comment section down below which of these 5 you would pick, and if it's none of them, let me know which other company you would personally pick for a high growth stock in your portfolio. Guys, thank you so much for watching. Thank you for sticking around to the end. I hope you found value in this video. But either way, don't forget to invest positively, and I'll see you in the next one.